In our previous session, we have learned about the elements of statement of financial position and statement of profit or loss as well as the format of the both statement. Now, we will look at this subtopic which accounting classification. Learning objective. At the end of this video, you should be able to identify the classification of items in statement of financial position and statement of profit or loss. In previous session, we already looked at the elements of statement of financial position and statement of profit or loss. Based on the elements of both statements, the business transactions can be classified into these 5 categories, which are assets, owner's equity, liabilities, revenues, and expenses. Assets. Now, I would like to ask a question. Do you know what is an asset? I believe that all of us know what an asset is. My next question is, do you have your own assets? Well, as a student, we might have a cash with us to finance our daily needs, debit card to withdraw some money from bank, and the most popular item which is smartphone. Those are valuable belongings to us. Therefore, those are our assets. So that's asset in our own perspective. Perhaps asset in business point of view is a bit different than our own view. Therefore, here we will look at the meaning of assets from a business perspective. Assets are the resources or items of value that the business owns and expected to generate economic benefit in the future. Assets in business perspective can be divided into 2 main categories: current assets and fixed assets or non-current assets. Current assets. Current assets are either cash or those can be converted into cash during or within a 12 months period, which are short-term in nature. Examples: debtors, or also known as account receivable, inventory, cash at bank, and cash in hand. Next, fixed assets or non-current assets. For these assets, they are acquired or bought not for resale, and it is to be used in the running of the business for a long-term basis which is more than 12 months period. Fixed assets can be divided into 3 categories: tangible assets, intangible assets, and long-term investments. We gonna look at each of these categories, one by one. The first one, tangible assets. Tangible assets is physical in existence which can be seen and touched. These assets are bought not for resale, but needed to run the business over an extended period of time. Examples are computer, motor vehicles, land and building, machinery, office furniture and equipments, and fixtures and fittings. Second, intangible assets. Assets which are non-physical existence, cannot be seen or touched. Examples: brand and trademark, copyrights, patents, and goodwill. The first 3 examples are quite familiar to us except for goodwill. What is goodwill? I will further explain about goodwill. Example of goodwill. The concept of goodwill comes into play when Company A acquires another company, which is Company B, is willing to pay a price significantly higher than the fair market value of the company's net assets. The elements or factors that make up the intangible asset of goodwill are comprised of things such as a company's good reputation, a solid, loyal, customer or client base, brand identity and recognition, an especially talented workforce, and proprietary technology. These things are, in fact, valuable assets of a Company B. However, they are not tangible, physical assets, nor can their value be precisely quantified. This is known as goodwill to Company A when Company A acquires Company B. The third one, long-term investments. Assets bought for the purpose of earning interest or dividend revenues. For examples: stocks, fixed deposits, and real estate investment. The next element is liability. Have you ever borrowed money from a friend? If yes, that's mean you know what liability is. Now, we will look at the liability term in business. Liabilities are amounts owed by the business to outside parties. Liabilities can also be seen as the external party's claims to the business assets. Liabilities are classified into current liabilities and non-current or long-term liabilities. Current liabilities are the debts or obligations of the business which are repayable within one accounting year. Examples are amounts owed to supplier of goods, which is known as creditor or account payable, a short-term loans, and bank overdrafts. Next, non-current or long-term liabilities are the debts or obligations of the business which are repayable in more than one accounting year. Examples: long-term loans and mortgage on a property. Next, owner's equity. Owner's equity represents owner-supplied fund to the business or the owner's claim on the business assets. Equity is made up of capital plus accumulated profits or minus with losses, then minus again with drawings. Capital is the amounts contributed by the owner to the business in form of cash or other assets, while the accumulated profits are the profits earned or minus with losses if the business suffer losses. And drawings are the cash or goods taken by the owner for personal use. It represents a withdrawal of profits and has the effect of decreasing equity. Next classification is revenue. Revenues in business perspective. Revenues are income generated by the business from the course of ordinary activities, which are the trading or normal operating activities. Revenues represents inflows of assets, such as from cash sales and credit sales, or reduction in liabilities, both of which result in increases in equity. Revenue generating activities are categorized into three main categories. First, from sale of goods. For examples, income for KFC is from the sales of fried chicken, and income for Bata Company is from the sales of shoes. Second, revenue from rendering of services. For example, fees of a legal firm, tuition fees, servicing fees of automobile workshop, and etc. And the last one, the revenue from the use of the business assets by others. For examples, rental income, interest income from the cash deposits in a bank, royalties from the use of a business patent, trademark, and copyright. And the last classification are expenses. Expenses in business perspective. Expenses are costs incurred in the normal course of business to generate revenues. Expenses can be categorized into four main categories. First, cost of sales. For examples, purchase of stock, freight, insurance, and transport cost, carriage inwards, for bringing the goods to the business premise, and discount allowed. Second, selling and distribution. Examples are salesmen's salaries and commissions, delivery charges for goods sold, carriage outwards, and depreciation of delivery vehicles. Third, administrative. Examples of expenditures are electricity and water, rental expense, stationery, depreciation of the car used by the manager, and salaries. Fourth, finance costs. Examples are interests on loans and bank service charges.